when we hear that the Federal Reserve is expected to cut interest rates next week, even though inflation is still not fully under control, the first question we should be asking is simple: why? Why would the Fed take this step right now when their main tool for fighting inflation is higher rates? The answer lies in the delicate balance between keeping the economy alive and fighting rising prices. Investment. High interest rates are great at slowing down inflation, but they also crush growth. Businesses borrow less, consumers spend less, and the housing market cools down. Too much of that, and you risk pushing the economy into a recession. That's why the Fed is stepping in with a cut. It's a way of saying, we think the slowdown is becoming more dangerous than inflation itself. But let's get practical. What does this actually mean for everyday Americans? If you're carrying credit card debt, this cut will slowly ease the pressure. Rates won't drop overnight, but the cost of borrowing begins to inch downward. For home buyers, mortgage rates could come down slightly. Good investment, opening doors for those who've been priced out of the market. Auto loans, student loans, and even small business financing all get a little cheaper. On the flip side, savers won't be thrilled. Lower rates mean lower returns on savings accounts, CDs, and money market funds. So while borrowers might breathe a sigh of relief, savers are going to feel the squeeze. Now, let's talk about the markets. Wall Street usually loves rate cuts. Stocks tend to rally because cheaper money fuels growth and encourages investment. Real estate also benefits as lower mortgage rates pull more buyers back into the game. But here's the catch. If inflation doesn't stay under control, those gains could be temporary. Rising prices erode purchasing power, corporate profits take a hit, and eventually the same market that cheered the cut could panic if inflation keeps creeping higher. In other words, this is not a free lunch. There's risk on the other side of the reward. Investment. So how do you prepare for this moment as an individual investor or saver? First, if you've got high interest debt, this is your chance to start paying it down while rates are moving lower. Second, if you're thinking of refinancing or buying a home, keep an eye on mortgage rates over the coming weeks. They may present a short window of opportunity. Third, diversify your investments. Don't assume that rate cuts guarantee a stock market boom. Spread your risk across equities, bonds, and even cash equivalents. Finally, don't forget about inflation. Everything makes a good investment. Make sure your money is working harder than the rate at which prices are rising. Because at the end of the day, it's not just about how much you earn or invest. It's about how much your money can actually buy. This upcoming rate cut is more than just a headline. It's a signal, a sign of where the economy is and where it might be headed. And whether you see it as good news or bad depends entirely on how prepared you are to respond. The Federal Reserve's decision to cut interest rates while inflation is still above target might sound contradictory at first, but it comes down to understanding the bigger picture of economic stability. For the past couple of years, the Fed has been raising rates aggressively to bring down inflation from historically high levels. And it worked. Prices have cooled compared to where they were, but not enough to reach the Fed's official 2% target. The problem is that keeping rates high for too long creates new risks: slower job growth and reduced consumer spending and weaker business investment. When money is expensive to borrow, companies delay expansion, households cut back on purchases, and the economy as a whole slows down. Eventually, if this trend continues, it can tip us into a recession. That's the tightrope the Fed is walking right now, choosing between keeping rates high to crush inflation or lowering them to prevent economic contraction. By signaling a cut next week, the Fed is essentially saying that the danger of a sharp slowdown outweighs the remaining risk of inflation. Think about it like this: inflation is like a fire that's still burning. Good investment, but the Fed believes the flames are small enough that they can take some water away without the fire spreading out of control again. They're not cutting because inflation is solved. They're not cutting because the cost of inaction might now be worse than the problem itself. Another factor here is the labor market. Job growth has cooled investment. Wage increases are moderating and unemployment is starting to inch upward. These are all signs that the high interest rate environment has done its job, but also that the pressure is mounting on workers and businesses alike. If layoffs start accelerating, consumer confidence falls, and people spend less, the economy could spiral into contraction much faster than expected. Good investment. The Fed wants to ease off the brakes before that happens. There's also a global element. Other central banks around the world have already begun lowering their rates to stimulate growth. If the Fed waits too long, The US dollar strengthens compared to other currencies, which makes American exports less competitive and adds another layer of strain to the economy. Cutting rates helps balance that out and ensures the US isn't left behind in global trade and growth. So when you hear about the upcoming cut, understand it's not about celebrating victory over inflation. It's about the Fed trying to keep the economy stable and avoiding a deeper downturn. This is a move designed to buy time, not declare the problem solved. When the Federal Reserve cuts interest rates, it's investment. The most immediate question for everyday Americans is simple: how does this affect me? The truth is, rate cuts ripple through nearly every part of personal finance, from the debt you carry to the money you try to save. For anyone with a credit card balance, lower rates are a small but meaningful relief. Credit card APRs won't suddenly drop to single digits, but as the benchmark rate comes down, banks slowly begin to pass that reduction on to consumers. That means less money lost to interest charges and a slightly easier path toward paying down balances. It's not life-changing overnight investment, but over months and years, those savings add up. Mortgages are another area where people will feel the difference. If you've been sitting on the sidelines waiting for a chance to buy a home, investment, a rate cut can open the door. Even a half-point reduction in mortgage rates translates into hundreds of dollars saved per month on a typical loan. That's the difference between qualifying for the home you want or being priced out entirely. For current homeowners, refinancing becomes an option again. Locking in a lower rate on your mortgage can save thousands over the life of the loan, and these opportunities tend to appear in cycles when the Fed pivots from raising rates to cutting them. Auto loans and student loans also become more affordable when interest rates drop. Buying a car, financing education, or starting a small business often requires borrowing, and lower rates mean the long-term cost of those decisions falls. That can encourage spending, which is exactly what the Fed wants: more activity, more growth, more circulation of money through the economy. Investment, but not everyone benefits. Savers actually feel the pain of lower rates. Those who park money in high-yield savings accounts, CDs, or money market funds will start to see returns shrink. What looked like an attractive 4 or 5% yield could gradually fall back toward 2 or 3%, eroding the incentive to keep money in savings. In other words, borrowers win when rates go down, but savers lose. The bottom line is that Fed rate cuts touch everyone differently. For people trying to manage debt or buy a home, this is good news. For those living off interest income or prioritizing safe savings, it's a setback. Understanding where you stand in that equation is the key to making the right financial moves as these changes unfold. When the Federal Reserve cuts interest rates, the stock market and real estate markets often react quickly, but not always in predictable ways. For the stock market, lower rates usually spark optimism. Companies can borrow money more cheaply, which allows them to expand, invest in growth, or manage debt more efficiently. Investors see that as a positive sign, so stock prices often rise. In addition, when rates fall, safe investments like bonds or savings accounts become less attractive, pushing more money into equities. This added demand can drive up stock prices, at least in the short term. However, investors should be cautious. A rate cut in the middle of high inflation isn't just a gift to the markets. It's also a signal that the economy might be facing underlying stress. If inflation picks back up because of cheaper money, investment, corporate profits could take a hit as companies struggle with higher costs. That's when the market can turn volatile, swinging between optimism and fear. Real estate is another sector that responds immediately to rate cuts. Mortgage rates tend to follow the Fed's moves, though not always in perfect sync. A rate cut makes borrowing cheaper, which draws more buyers into the housing market. For sellers, this increased demand often translates into higher home prices. For buyers, it means renewed competition, bidding wars, and in some cases, paying more for the same property than they would have if rates had stayed higher. Homeowners looking to refinance may also see new opportunities to lower their monthly payments, freeing up cash for other spending or investing. But there's a risk here too. If demand surges too quickly in housing, prices could jump faster than incomes, making affordability an even bigger problem. That's especially concerning when inflation is still not fully under control. Cheaper mortgages might help buyers today, but if overall costs of living keep climbing, homeowners could find themselves stretched thin despite locking in a better rate. For investors, the takeaway is to see both the upside and the risk. Stocks and real estate may enjoy a short-term boost, But the long-term picture depends on whether inflation cools or reignites. A rate cut can act like fuel for the markets, but fuel can either power steady growth or spark a fire that burns out quickly. Investment, timing, and risk management become more important than ever in this environment. Whenever the Federal Reserve cuts interest rates, the smartest move is not to get caught up in the headlines, but to think carefully about how you can position yourself financially. The first and most practical step is to look at your debt. If you're carrying balances on high interest credit cards or variable rate loans, a rate cut is your opportunity to make progress. Even small reductions in interest rates can free up money that would otherwise be lost to lenders. Using this window to aggressively pay down those balances can save you thousands over time. A good investment. It's not about timing the market. It's about taking advantage of a shift that makes your financial burden lighter. The housing market is another area where preparation matters. If you've been considering buying a home, lower mortgage rates can open doors that were previously closed. The difference of even half a percent can drastically change your monthly payment and overall affordability. Investment. But that doesn't mean you should rush blindly into a purchase. Lower rates tend to increase demand, which drives up prices. The key is to stay patient, watch the market, and be ready to act if the right deal comes along. For current homeowners, this might also be the time to explore refinancing. Locking in a lower fixed rate can stabilize your payments and give you more breathing room in your monthly budget. On the investment side, diversification becomes essential. Lower interest rates often push investors into riskier assets like stocks and real estate, hoping for higher returns. While these areas can benefit in the short term, you don't want all your wealth exposed to the same risks. Bonds, dividend-paying stocks, or even inflation-protected securities can provide balance, ensuring your portfolio can withstand both growth periods and inflationary pressures. Finally, keep inflation at the center of your decision-making. A rate cut might stimulate growth, but if it also allows inflation to flare back up, the value of your money erodes more quickly. That's why your strategy should include investments that have a history of outpacing inflation, whether that's certain equities, real estate, or carefully chosen alternative assets. In short, preparing financially isn't about chasing quick wins. It's about using lower rates as a tool, reduce your debt, explore opportunities in housing, diversify your investments, and protect yourself from inflation. By doing so, you turn a broad economic policy shift into a personal financial advantage.